Look, I'm not going to sugarcoat this. What's happening in the silver market right now is something most people won't see coming until it's too late. And by then, the opportunity will be gone. Not reduced, not diminished. Gone. Let me paint you a picture of what's unfolding right before our eyes. Silver just hit record highs, and while everyone's celebrating, very few people understand what this actually means. This isn't just another bull run. This is the beginning of something that hasn't happened in the silver market in over 4 decades. Here's what you need to understand. Silver is in its 5th consecutive year of supply deficit. 5th year. That means for 5 straight years the world has consumed more silver than it has produced, and it's not even close. We're talking about a structural deficit that's eating through above-ground inventories at an alarming rate. Now, you might be thinking, wait, okay, supply deficit, I get it. But why should I care right now? Because the deficit is accelerating. Industrial demand alone accounts for more than half of all silver consumption, and that demand is exploding. We're not talking about jewelry or investment demand here. We're talking about solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems. These are non-negotiable uses. You can't build a solar panel without silver. You can't manufacture an electric vehicle without it. And the world is racing toward electrification at breakneck speed. Let me give you some context. A single solar panel uses about 20 grams of silver. Doesn't sound like much, right? But when you're installing hundreds of millions of solar panels globally every year, that adds up fast. The solar industry alone is projected to consume over 150 million ounces of silver annually, and that number is growing. Electric vehicles? Each one requires about 25 to 50 grams of silver for various electrical components. With EV adoption accelerating worldwide, we're looking at exponential growth in silver demand from this sector alone. But here's where it gets really interesting. While industrial demand is surging, mine production is essentially flat. Silver mining hasn't seen significant new discoveries in years. Most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. So when those base metal prices are low, or when those mines face operational challenges, silver production suffers. And right now, we're seeing exactly that scenario play out. The major silver-producing countries are facing serious headwinds. Mexico, the world's largest silver producer, has been dealing with regulatory challenges and security issues that have impacted production. Peru, the second-largest producer, has faced social unrest and environmental protests that have shut down major mining operations. China, another major producer, is keeping more of its silver domestically to feed its own industrial appetite. The supply side of this equation is under immense pressure, and there's no relief in sight. Now let's talk about what the smart money is doing. Central banks have been accumulating gold at record levels, but what most people don't realize is that silver is starting to attract institutional attention in ways we haven't seen since the early 1980s. Major investment funds are positioning themselves in silver, recognizing that the supply-demand fundamentals are unlike anything we've seen in modern markets. The COMEX silver inventories have been declining steadily. These are the registered stocks, the silver that's actually available for delivery. We've seen drawdowns that would have been unthinkable just a few years ago. And when you combine declining inventories with rising industrial demand and increasing investment demand, you create the perfect setup for a price explosion. Let me tell you a story that illustrates what's happening. Back in 1980, silver hit its all-time high of $50 per ounce. That was driven primarily by the Hunt brothers trying to corner the market, combined with high inflation and geopolitical uncertainty. The market was much smaller then, and it was largely driven by speculation and investment demand. Today's situation is fundamentally different and, in many ways, more powerful. Today, we have genuine industrial demand that cannot be substituted. In 1980, if silver got too expensive, industries could find alternatives or reduce usage. Today, there are no viable substitutes for silver in most of its critical applications. You cannot make a solar panel work without silver. You cannot manufacture the electrical components in an electric vehicle without it. The conductivity properties of silver are unmatched, and in many high-tech applications, it's irreplaceable. Think about what this means. We have inelastic industrial demand meeting constrained supply. This is Economics 101, but on steroids. When demand is inflexible and supply cannot respond quickly, prices have only one direction to go, and we're seeing the early stages of this dynamic playing out right now. But there's another layer to this story that most people are missing: the paper silver market versus the physical silver market. The vast majority of silver trading happens on paper, through futures contracts and ETFs. These paper claims on silver far exceed the actual physical silver available. It's estimated that there are over 100 paper ounces traded for every physical ounce that exists. This works fine in normal markets, but when physical demand surges and people start asking for delivery, the system gets stressed. We saw a preview of this during the Reddit-driven silver squeeze attempt. While that movement didn't achieve its stated goals, it did reveal something important. The physical silver market is much tighter than most people realize. Premiums on physical silver coins and bars spiked dramatically. Dealers ran out of inventory. Mints couldn't keep up with demand. And that was just from retail investment demand. Imagine what happens when industrial users start competing more aggressively for physical metal. Here's something that should concern anyone paying attention. The London Bullion Market Association, which oversees the professional bullion market, has been reporting declining silver stocks in their vaults. These are the vaults that supply the global wholesale market. When these inventories decline, it signals that physical metal is being pulled out of the system faster than it's being replenished. This is not a temporary blip, this is a structural shift. Now let's talk about the monetary aspect of silver. Throughout history, silver has been money. For thousands of years, silver coins were the primary medium of exchange for ordinary people. Gold was for kings and large transactions, but silver was the people's money. That monetary history never really disappeared, it just went dormant during the era of fiat currency. But something interesting is happening now. As confidence in fiat currencies erodes, as central banks print money at unprecedented rates, as inflation becomes a persistent concern, people are rediscovering silver's monetary properties. It's more affordable than gold, making it accessible to average investors. It's tangible, unlike digital currencies, and it has thousands of years of history as a store of value. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. That's based on the natural occurrence of these metals in the Earth's crust. Today, that ratio is much higher, meaning silver is historically undervalued relative to gold. Even a partial reversion to historical norms would mean a significant repricing of silver. Quick aside here, because this is important for anyone thinking about their financial future. If you're sitting on a substantial retirement account, $100,000 or more, you might want to look into how gold IRAs work. I've put together a comprehensive guide that covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. It's about diversification and protecting wealth you've spent decades building. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the silver market right now. The convergence of factors we're seeing is unprecedented. You have industrial demand at all-time highs and growing. You have supply that's constrained and unable to respond quickly. You have declining inventories across all major storage facilities. You have increasing investment demand as people wake up to the fundamentals. And you have a monetary environment where hard assets are becoming increasingly attractive. Let me walk you through what happens next if these trends continue. As industrial users compete more aggressively for available supply, they'll be willing to pay higher prices. They have no choice. A solar panel manufacturer cannot stop production because silver is expensive. An EV manufacturer cannot halt assembly lines. These industries will pay what they must to secure supply. This creates a floor under silver prices that keeps rising. As prices rise, investment demand typically increases. People see silver moving higher and want to participate. This creates additional demand pressure. But here's the critical point. Unlike other commodities where higher prices bring out more supply, silver supply cannot respond quickly. You cannot just open a new silver mine overnight. It takes years, sometimes decades, to bring new production online. And remember, most silver is a byproduct of other mining, so increasing silver production requires increasing production of copper, lead, or zinc, which have their own market dynamics. The result is a market that's increasingly tight, with prices that need to rise significantly to ration available supply. We're not talking about a 10% or 20% move here. We're talking about a fundamental repricing of silver to reflect its true scarcity and utility in the modern economy. Now, let's look at what happened in previous silver bull markets to understand the potential magnitude of what's coming. In the late 1970s, silver went from around $4 per ounce to $50 in just a few years. That was a 12-fold increase. In 2011, silver rallied from around $10 to nearly $50 again. These weren't gradual moves. These were explosive rallies that caught most people off guard. But here's what's different this time. Those previous rallies were driven primarily by monetary concerns and speculation. This rally is being driven by fundamental supply-demand imbalances in the physical market. This is more sustainable, more powerful, and potentially more dramatic than anything we've seen before. Think about the implications. If silver is genuinely in a structural deficit, if industrial demand continues to grow, if supply remains constrained, then we're not looking at a temporary price spike. We're looking at a multi-year bull market that could take silver to levels that seem unthinkable today. Some analysts are talking about $100 per ounce. Others are suggesting even higher levels. These aren't wild-eyed speculators. These are serious market analysts looking at the supply-demand fundamentals and extrapolating where prices need to go to balance the market. Let me give you another perspective on this. The total value of all the silver ever mined and still in existence is relatively small compared to other asset classes. It's a fraction of the gold market, a tiny fraction of the stock market, and almost negligible compared to the bond market or real estate. This means that even a small shift in investment flows towards silver could have an outsized impact on prices. If just 1% of global investment capital decided to allocate to physical silver, the price impact would be enormous because there simply isn't enough physical silver available to absorb that demand. We're also seeing changes in how silver is being held. Increasingly, investors are choosing to hold physical silver rather than paper claims. They're buying coins, bars, and storing them in private vaults or at home. This removes silver from the available supply pool permanently, or at least until prices rise significantly. Every ounce that moves from the wholesale market into private hands is an ounce that's no longer available for industrial use or investment demand. This creates a one-way flow that tightens the market further. The geopolitical dimension of this cannot be ignored either. As tensions rise globally, as countries seek to reduce dependence on the dollar-dominated financial system, precious metals become increasingly important. Silver, being more affordable than gold, becomes an attractive option for countries looking to diversify their reserves. We're seeing this play out in real time as nations accumulate precious metals at rates not seen in decades. There's also the technological angle. New applications for silver are being discovered and developed constantly. Silver's unique properties, its conductivity, its antibacterial characteristics, its reflectivity, make it invaluable in cutting-edge technologies. From advanced medical devices to next-generation electronics to space exploration, silver is becoming more critical, not less. Each new application adds to the demand side of the equation without adding anything to supply. Let's talk about the mining industry for a moment. Silver miners are not in great shape to respond to higher prices. Years of low prices have led to underinvestment in exploration and development. Many silver mines are aging, with declining grades and rising costs. The easy silver has been mined. What remains is more difficult and expensive to extract. This means that even if prices rise significantly, the supply response will be muted and delayed. Environmental regulations are also making it harder to open new mines or expand existing ones. This is particularly true in developed countries where most of the regulatory framework is strictest. While these regulations are important for environmental protection, they do constrain supply. And in a market that's already tight, any constraint on supply has magnified effects. The recycling market for silver is also limited. Unlike gold, where a large percentage is recycled, much of the silver used in industrial applications is consumed in ways that make recycling difficult or uneconomical. The silver in a solar panel, for example, is not easily recovered. The silver in electronic components is often in such small quantities that recycling isn't cost-effective. This means that industrial demand is truly consuming silver, removing it from the available supply pool. Now, I want you to think about your own situation. If you're watching this, you're probably someone who pays attention to markets, who thinks about protecting and growing wealth, who understands that the financial landscape is changing. The question you need to ask yourself is, am I positioned for what's coming in the silver market? This isn't about speculation. This isn't about trying to time the market perfectly. This is about recognizing a fundamental shift in supply and demand dynamics and positioning yourself accordingly. The people who will benefit most from what's coming are those who act before the crowd realizes what's happening. Once silver is making headlines, once it's the topic of conversation at dinner parties, once your neighbor is talking about it, the easy gains will be gone. History shows us that markets can remain irrational longer than you can remain solvent, but it also shows us that fundamentals eventually win. The fundamentals in the silver market are screaming that prices need to be higher, much higher. The only question is timing, and while no one can predict exact timing, the setup is as compelling as anything I've seen in decades of watching markets. Consider what happens if you wait. If the thesis plays out, If silver does enter a sustained bull market driven by these fundamental factors, prices could move quickly. We've seen this before. Silver can be a quiet market for years, and then suddenly it's not. It gaps higher, premiums on physical metal spike, and availability becomes an issue. By the time you decide to act, you might find yourself paying significantly more or struggling to find physical metal at any price. The smart approach is to position yourself now while the market is still relatively quiet, while physical metal is available at reasonable premiums, while most investors are focused elsewhere. This is how wealth is built, by recognizing opportunities before they become obvious to everyone else. Let me be clear about something. I'm not suggesting you bet the farm on silver. I'm not suggesting you take reckless risks. What I am suggesting is that, given the fundamental setup, given the supply-demand dynamics, given the monetary environment, silver deserves serious consideration as part of a diversified portfolio. The risk-reward profile is compelling. The downside is limited by industrial demand and production costs. The upside is substantial if the fundamental thesis plays out. Think about the world we're living in. Governments are running massive deficits. Central banks are trapped between inflation and economic growth. The dollar's role as the global reserve currency is being questioned. Technology is advancing rapidly, requiring more silver for critical applications. The energy transition is accelerating, demanding massive amounts of silver for solar panels and electrical infrastructure. All of these trends point in one direction: higher silver prices. The supply deficit we're experiencing isn't going to resolve itself quickly. It takes years to bring new mines online. It takes time for recycling infrastructure to develop. Meanwhile, demand continues to grow. Every electric vehicle produced, every solar panel installed, every 5G tower erected consumes silver. This is not demand that can be postponed or substituted away. This is structural, growing demand meeting constrained supply. What we're witnessing is the early stages of a repricing event. Silver has been undervalued for years, trading more like an industrial metal than the monetary metal it has been throughout history. As the market wakes up to the supply constraints, as industrial users compete more aggressively for available metal, as investors recognize the opportunity, we're going to see a repricing that reflects silver's true value in the modern economy. The window of opportunity is closing, not because I say so, but because the fundamentals dictate it. Every day that passes, inventories decline a bit more. Every day, industrial demand consumes more silver. Every day, more investors wake up to what's happening. The question isn't whether silver prices will rise. The fundamentals make that almost inevitable. The question is whether you'll position yourself before the move becomes obvious to everyone else. This is your moment. This is the opportunity that comes along once in a generation. The setup is clear, the fundamentals are compelling, and the timing is now. Don't let this pass you by. Don't be the person who looks back in a year or two and says, "I saw it coming, but I didn't act." The information is in front of you. The opportunity is here. What you do with it is up to you, but I can tell you this. The people who act decisively in moments like this are the ones who build lasting wealth. The time to move is now, before the crowd realizes what's happening, before prices gap higher, before physical metal becomes scarce. This is your last chance to position yourself ahead of what could be the most significant move in the silver market in decades. Don't waste it.